Right now, the cure for tomorrow's deadliest diseases relies entirely on a multi-billion-dollar company that, well, they don't actually invent any drugs.
Yeah, I mean, it sounds like a paradox, right? But it's actually the absolute reality of modern medicine.
Welcome to today's deep dive. Normally, when you look at a corporate earnings report, you're just staring at a wall of spreadsheets, right? Margins, financial jargon, all that.
Absolutely. It's incredibly easy to just look at the bottom line, see that a company made money, and move on.
Exactly. But if you know how to read these documents, they aren't just scorecards. They're actually secret maps. They show you exactly where the money, the brain power, and the innovation are flowing in real time.
Right, across the entire global economy.
So whether you are, prepping for an investment meeting, trying to catch up on the biotech sector, or if you're just insanely curious about how the massive machinery of healthcare functions behind closed doors, this deep dive is custom tailored for you.
And we are looking at a very specific set of coordinates on that map today. Our source material is a dense stack of documents, specifically the April 22, 2026 press release and the presentation slides for the Q1 2026 financial results of Medpace Holdings.
Okay, let's unpack this. Before we get into the billions of dollars flying around those spreadsheets, we really have to establish what Medpace actually does because, well, they're somewhat invisible to the general public.
Yeah, they really operate behind the scenes.
Right. So Medpace is a contract research organization, or a CRO. If you aren't living and breathing biotech every day, think of a CRO as the operational engine of clinical trials.
That's a great way to put it.
Because, like, a brilliant scientist at a tiny startup might invent a miraculous new molecule in a petri dish. But getting that molecule from a lab into a human being, proving it's safe, proving it works.
And navigating the incredibly strict FDA regulatory hurdles.
Exactly. That requires a massive global infrastructure. So they hire a CRO like Medpace to actually run the trials, manage the patients, and gather all the data.
And that operational engine is what makes Medpace such a fascinating leading indicator for the entire medical field. Decoding their financial health. It isn't just about Medpace's stock price.
Right, it's bigger than that.
Much bigger. It gives us a window into the health of the broader search for tomorrow's cures. And looking at these Q1 2026 numbers, the engine is running incredibly hot. But, the dashboard is also flashing a few complex warning lights about the macroeconomic road ahead.
Oh, well, I want to start with how hot that engine is running right now, because I'm looking at the now versus the next in these slides, and the now is frankly staggering.
It really is. The top line numbers are huge.
Yeah, Q1 2026 revenue was $706.6 million. That is a 26.5% jump from the exact same quarter last year.
Which is wild. A nearly 30% jump for a company of this size is just massive.
Right, and it's not just top-line vanity metrics either.
No, the profitability mechanics here are what really stand out to me. Net income hit $123.9 million. That's $4.28 per share.
Wow.
Yeah. And let's look at EBITDA, which is essentially a measure of their pure operational profitability before things like interest and taxes get involved. Their EBITDA reached $149.4 million.
So that pushes their margin to, what, over 21%?
Exactly, over 21%.
I mean, for a service-based business with over 6,300 employees worldwide, a 21% margin seems incredibly high. They aren't manufacturing software that costs $0 to copy, right?
Right. They have real human capital costs.
Yeah, they are paying highly specialized doctors, data scientists, and trial managers all over the globe.
And that right there is the premium commanded by deep scientific expertise. They aren't just doing data entry. They are designing highly complex regulatory strategies. But to really grasp how they pulled in over $700 million in just 3 months, we have to look at the mechanics of their backlog.
Because the CRO industry doesn't work like retail, right?
Exactly. You don't sell a product today and instantly collect the cash. You sign a complex, multi-year contract to run a clinical trial. The total value of that contract sits in what they call a backlog.
Okay, so it's promised money.
Right. You only get to recognize that money as revenue when you actually perform the work like enrolling a patient, hitting a clinical milestone, or delivering a data set.
So the backlog is essentially a mountain of promised future revenue. And according to the Q1 slides, Medpace's backlog is sitting at just over $2.9 billion.
Yeah, almost $3 billion. But the critical operational metric isn't just the size of the mountain, it's how fast they are mining it.
Okay, how fast are they mining it?
Their backlog conversion rate for this quarter jumped to 23.3%. To give you some context, a year ago in Q1 2025, it was 19.2%.
Oh, wow. So they are churning through those promised contracts significantly faster than before.
Significantly faster.
So they are highly efficient right now, just getting the work done and turning theoretical future money into actual recognized revenue.
Yep, that is the sign of a finely tuned operational machine. However, and this is a big however, if you are burning through a $2.9 billion backlog at a highly accelerated rate, the only way to sustain that machine is to constantly shovel new coal into the furnace.
Right, which brings us to the first mystery of this earnings report. We have to shift from the now to the next.
Exactly. We have to look at the net new business awards.
Right, the new contracts signed this quarter. So in Q1 2026, Medpace brought in $618.4 million in net new business. Now, in a vacuum, booking over $600 million in new work sounds fantastic.
Sounds great on paper.
But wait, if they recognize $706 million in revenue this quarter, but only book $618 million in new business, the pile is actually shrinking.
It mathematically has to shrink. This dynamic results in what the financial industry calls the net book-to-bill ratio. For Medpace this quarter, it sits at 0.88x.
Let me make sure I'm wrapping my head around this mechanic. Is this sort of like running a highly popular restaurant that is absolutely packed to the walls tonight?
Okay, I like where this is going.
Like everyone is eating, the kitchen is firing on all cylinders, the cash register is ringing nonstop. But when you walk up to the host stand and look at the reservation book for next month, it's looking noticeably light.
Yes.
They are cooking the meals today faster than new reservations are coming in for tomorrow.
What's fascinating here is how that analogy highlights the temporal disconnect in a service-based business. The dining room today is the 26.5% revenue growth.
Right.
But the reservation book is the 0.88x book-to-bill ratio. A ratio of 1.0 means you are replacing exactly what you consume. Anything below 1.0 means your reserves are depleting.
I have to play devil's advocate here, though. Is a single quarter at 0.88x really a crisis for a company sitting on nearly $3 billion in backlog?
That's a fair question.
I mean, it feels like panicking over a slow Tuesday at a restaurant that's already booked out for a year.
Oh, I wouldn't call it a crisis, and the market shouldn't either. In fact, if you zoom out and look at their last 12 months, or LTM book-to-bill ratio, it is still sitting slightly positive at 1.03x.
Okay, so over a full year, they are still ahead.
Exactly. But that 0.88x for this specific quarter is a critical leading indicator. It tells us that out there in the broader macroeconomic environment, the pace of new trials being funded and initiated has slowed down relative to Medpace's massive capacity to execute them.
Well, if that reservation book is looking light, we need to ask who exactly is failing to make those reservations. Who are Medpace's clients?
That is the right question to ask.
Because digging into the revenue composition slides reveals what might be the most defining and, frankly, potentially risky characteristic of this entire company.
Yeah, it is entirely by design, but it does expose them to very specific market forces.
A massive 79% of Medpace's revenue comes from what they classify as small biopharma.
Yep, nearly 80%.
We are talking about companies with less than $250 million in annual sales. Only 16% of their revenue comes from mid-sized biopharma, and a mere 5% comes from the giant, large pharma companies.
And if you look closely, their top 10 customers combined only make up 30% of their total revenue.
So their client base is highly decentralized across hundreds of these tiny companies.
Highly decentralized.
Here's where it gets really interesting to me. 79% small biopharma. That feels like building a massive national power grid. But instead of relying on one or two giant, steady nuclear reactors like a Pfizer or a Johnson & Johnson, you're relying on hundreds of unpredictable, small-scale windmills. Small biotech companies don't have steady revenue, right? They live and die by their venture capital funding rounds.
They absolutely do.
So if the macroeconomic environment gets tough, like if interest rates stay high and venture capital dries up, isn't it a massive vulnerability for Medpace to rely almost entirely on these little guys? When the wind stops blowing, the windmills stop turning.
This raises an important question about how modern drug development actually functions behind the scenes. Your windmill analogy is apt regarding the volatility of funding, but we have to look at why Medpace built this specific power grid.
Okay, why rely on the windmills?
The reality of the modern pharmaceutical industry is that large pharma, the nuclear reactors, they don't actually invent the majority of new drugs anymore.
Wait, really?
No, they've effectively outsourced early-stage research and development. The vast majority of cutting-edge, high-science innovation is happening at those scrappy, cash-burning startups.
Ah, I see. So a giant pharmaceutical company just waits for a startup to prove the science works and then buys the startup outright to handle the global commercialization and marketing.
Yes, exactly. And because of that dynamic, small biopharma is the most active sector in clinical research.
That makes sense.
But a startup with 50 employees and a brilliant new oncology molecule simply does not have the internal infrastructure to run a massive multinational clinical trial.
Right, they're scientists, not global logistics experts.
Precisely. They don't have regulatory experts in 30 different countries. They literally need an outsourced partner.
So Medpace steps in to be that infrastructure.
And look at the therapeutic areas Medpace focuses on. It perfectly mirrors where the most complex, high-reward venture capital is flowing. 31% of their revenue is in oncology or cancer research,
Wow, almost a third.
and another 23% is in metabolic diseases. Think of the current absolute boom in weight loss and diabetes drugs.
Those are incredibly complex, highly scrutinized fields. You don't just hand an oncology trial to a bargain basement operation.
Definitely not.
The FDA protocols for patient safety and data integrity are immense.
Which is exactly why Medpace's 21% EBITDA margin is protected.
Yeah.
They offer deep scientific and regulatory expertise that a small startup just cannot replicate.
Right.
However, your initial point about the vulnerability remains completely valid. When venture capital tightens due to high interest rates, these small biopharma companies are the first to feel the pinch.
Because they can't borrow money cheaply.
Right. They might have to delay starting a new phase 2 trial just to conserve cash.
And a delayed trial from a small biopharma client directly translates into Medpace's 0.88x book-to-bill ratio.
Exactly.
The client simply doesn't have the venture capital cash to book the reservation.
That is the direct causal link. Medpace is capturing the most innovative sector of the market, but they are also fully exposed to its macroeconomic funding cycles.
Well, if you're going to rely on a power grid of unpredictable windmills, you need a massive battery backup for when the wind dies down. You need a financial safety net to absorb those macroeconomic shocks.
You really do.
So let's look at Medpace's balance sheet to see how resilient they really are.
The cash mechanics of this company are, frankly, formidable.
Let's talk numbers, because in just Q1 2026, they generated $151.8 million in operating cash flow. And when you look at free cash flow, they are sitting at $145.0 million.
For those not deep in the financial weeds, free cash flow is essentially the oxygen of a business.
Right.
Is the actual cash left over after the company has paid for all its necessary capital expenditures, like updating technology or expanding their facility.
And their ability to generate that oxygen is wild. It's a 97.1% free cash flow conversion rate.
That number is incredible.
Almost every single dollar of their operational profitability is turning directly into usable liquid cash in the bank. Because of this, they are currently sitting on a cash pile of $652.7 million.
Keep in mind, that cash pile has grown incredibly fast due to a very specific strategic pause.
What kind of pause?
Well, if you look at the historical data in the presentation, back in the first half of 2025, Medpace spent over $900 million on share repurchases.
Oh, wow. Buying back their own stock.
Exactly. But in the second half of 2025 and here in Q1 of 2026, they completely turned off that share repurchase program. They spent zero on it this quarter.
Zero.
Zero. When a machine with a 97% conversion rate stops buying back shares, the cash just stacks up instantly.
I'm going to push back on that strategy, though. If they are suddenly hoarding $650 million in cash and completely stopped their massive buyback program, doesn't that imply management is actually terrified of a market slowdown?
That's a common interpretation, sure.
I mean, if they were truly confident in their future, wouldn't they be aggressively reinvesting that cash into the business, buying up competitors, or continuing to buy their own stock? Pulling the cash inward feels defensive.
I'd view it less as terror and more as calculated optionality. Having $650 million in liquid cash provides an immense buffer.
A giant safety net.
A giant safety net, exactly. It means that even if the venture capital funding environment for their small biotech clients deteriorates further, Medpace has the luxury of time.
Oh, I see.
They don't have to panic discount their services to win contracts just to keep the lights on. They can simply execute the $2.9 billion in work they already have, maintain their high margins, and wait for the macro environment to stabilize.
That makes a lot of sense.
Yeah.
And their forward-looking guidance supports the idea that they aren't panicking. For the full year of 2026, they are projecting total revenue between $2.75 billion and $2.855 billion. That represents roughly 9% to 13% growth year over year. They are also projecting full-year net income of around $500 million.
That guidance is the clearest signal yet. Despite the book-to-bill ratio dipping below 1.0, internal management clearly sees enough guaranteed revenue in their existing backlog and enough activity in their sales pipeline to confidently promise the market double-digit growth.
Okay, so what does this all mean when we throw a major executive change into the mix?
Ah, yes. The leadership shakeup.
Right in the middle of navigating this shifting macro environment. The press release notes that on April 21st, literally the day before this earnings report dropped, President Jesse Geiger announced his resignation, effectively retiring on May 31st, 2026.
A very tight timeline.
Very tight. And instead of bringing in fresh blood, the CEO, August Trendle, is just going to reassume the role of president himself.
You know, the timing of executive departures is always heavily scrutinized by investors, especially when leading indicators like the book-to-bill ratio are softening.
Exactly. You have the sub-1 ratio indicating a potential slowdown in new work. You have them hoarding cash, and suddenly the president leaves. It is very easy to look at that combination and assume internal turmoil.
It is. But if we connect this to the bigger picture, the mechanics of this specific transition actually lean heavily towards steadying the ship.
How so?
Well, the press release goes out of its way to explicitly state this departure is a retirement, not the result of any disagreement regarding operations or strategic practices.
And August Tronel isn't just a hired gun CEO, right? He is the founder of Medpace. He's been the driving force since its inception.
Which is the crucial psychological factor here. Imagine you are one of those small biopharma startups.
Okay.
You have 20 employees, a limited runway of venture capital cash, and your entire company's survival depends on Medpace successfully running your oncology trial.
That's a lot of pressure.
Huge pressure. So seeing the founder of your clinical partner reconsolidate control during a period of macroeconomic turbulence is actually deeply reassuring.
Oh, I get it. It signals absolute continuity.
Exactly. There won't be some new executive coming in to radically pivot the strategy or disrupt the operational flow.
It's the founder stepping back onto the factory floor to make sure the machine keeps humming.
Precisely.
The strategy remains identical. Execute the massive backlog efficiently, maintain those 21% margins, and let the cash pile up. They have decentralized their risk across hundreds of therapeutic innovations, but centralized their operational control to weather any storms.
It is a remarkably resilient business model when executed correctly. They have effectively made themselves indispensable to the most vulnerable yet most innovative segment of the pharmaceutical world.
Well, we have covered a massive amount of ground today, and I want to pull all these threads together. We started by looking at Medpace as an absolute operational powerhouse right now.
Right, fire on all cylinders.
Exactly. Q1 2026 showed them generating over $700 million in revenue, churning through their $2.9 billion backlog with incredible efficiency, and generating cash at a 97% conversion rate.
But we also decoded the tension beneath those top-line numbers. That 0.88x book-to-bill ratio is a vital warning light.
Yeah, demonstrating how even an efficient machine is susceptible to the broader funding environment of its clients.
Right, because of their unique intentional reliance on small biopharma startups for 79% of their revenue.
Which is a double-edged sword. By acting as the outsourced infrastructure for hundreds of scrappy, cutting-edge biotech firms, Medpace has positioned itself at the absolute bleeding edge of medical innovation, particularly in complex fields like oncology and metabolic research.
But it also means they are directly exposed to the shifting winds of venture capital.
Fortunately, they are facing those winds with a massive $650 million cash battery and the stabilizing presence of their founder retaking the reins, allowing them to project confident double-digit growth for the rest of 2026.
It's going to be fascinating to watch how they navigate the rest of the year.
It really is. Which brings us back to why you, the listener, should care about the mechanics of a contract research organization. The next time you open a news app and read a headline about an incredible breakthrough cancer treatment Or a revolutionary new diabetes drug discovered by some tiny biotech startup you have never heard of. You now know the secret behind the curtain.
That's the real takeaway here.
The scientists may have invented the molecule in a lab, but the global, behind-the-scenes engine that actually ran the trials, navigated the complex FDA regulations, and validated that science to get it into the hands of patients, is more than likely a CRO, just like Medpace.
They truly are the quiet giants of the healthcare ecosystem. Without their outsourced infrastructure, the modern innovation pipeline essentially grinds to a halt.
Which brings me to a final, lingering thought to mull over as we wrap up. We've seen how deeply these small, innovative biotech companies rely on CROs to survive. If contract research organizations are the ultimate gatekeepers, holding the trial data and providing the operational engines for nearly 80% of small biotech companies, are we moving toward a future where the CROs, sitting on mountains of cash and specialized expertise, actually hold more power over global drug development timelines than the giant pharmaceutical companies themselves?
Now, that is a profound shift in the balance of industry power. The map is definitely changing.
It certainly is. Thanks for joining us for this deep dive. We'll see you next time.